One of the other things we like to talk about as fund managers generally is something called the Sortino ratio. I know it's a pretty boring investment term, but it's actually quite a useful investment term. So what is the Sortino ratio? So really it's a score that says how much good stuff do I get for every bit of bad stuff that actually matters. So in investment terms, it's a score that measures the return you get for the amount of downside volatility you take in that investment. And why is this useful? I think because in investing, we don't mind good volatility, which is really making more money than expected. So upside volatility is a good thing. We only really want to measure the bad volatility where we're losing money. The Sortino ratio tells you how well the investment's done in the amount of risk it's taken only when things go wrong. So if you think of volatility as a measure generally, it will measure upticks in markets, downticks in markets, and it'll weight them the same. The Sortino ratio doesn't worry about the upside. Obviously, if the fund's doing better than expected, that's a good thing. What we're worried about is making sure that we protect on the downside. So we want to minimize the negative volatility in the portfolio. So I think a way to think about this is if two funds have the same profit, but one does it with fewer nasty losses, it'll have a higher Sortino ratio. And I would imagine less anxiety for the clever people that invested in it. So the summary here is a higher Sortino ratio means more of the good stuff, i.e. returns, for less of the bad stuff, i.e. market drawdowns.